We got our PPI data this morning at 8:30 a.m. and I will say this was probably one of the worst case scenarios that could have unfolded if you're looking for a Santa Claus rally. We're going to dive into the price action, the report itself, and we're going to discuss some trades for today and the outlook moving forward. The PPI came in at 8:30 a.m. promptly. The market was looking for a consensus month-over-month increase of 0.2%, and we had a month-over-month increase of 0.3%. Is it the end of the world in terms of the actual data set? Not the end of the world, but we all know that the market moves off of what's the expectation and what is the actual, and that did not look so good today. Our core PPI actually was expected to come in at plus 0.2% month-over-month. It came in at plus 0.4%. And interestingly enough, I see a lot of takes out there, a lot of analysis, a lot of research that's saying, man, this wage growth is just so bad. It's causing higher inflation. This is not good. When you look under the hood and you see what was really driving that higher than expected PPI, we see that the cost of services went up 0.4%, the biggest gain in 3 months. This was led by securities brokerage, dealing, investment advice, and related services, which jumped 11.3%. That is so random. That does not have a direct tie to employee wages or anything like that. I mean, a lot of Americans don't even have investment accounts, maybe like half the population. And then also we had the cost of goods edged up 0.1%. This was led by a 38.1% surge in the prices for fresh and dry veggies. And it says gasoline prices dropped 6%. So vegetable prices, are those tied to Billy Bob, Joe Schmo, Joe Sixpack getting a 5% raise at his day job? No, not really. I mean, most likely that has led to some sort of supply shock. So these are pretty, just like random things that are increasing in price. I don't believe they're directly related to consumers just being, oh man, these people are just too employed. It's a problem and we need to drive everything into a recession. But nonetheless, that is what happened today. I will say that the year-over-year metrics, whether it was core PPI or non-core, they both declined reasonably. We had the actual at 7.4%. The previous reading was 8.1%. So this is a decline. But again, the consensus was that we were going to decline all the way to 7.2%. And then, of course, the Michigan consumer sentiment comes in at 10 a.m. and it comes in a little bit better than the expectation. So the market is really just dealing with issues from all angles. One is everyone thinks we're going to enter a recession, so that's bad. So everyone's like, the earnings are going to decline. But with that, you would think if we entered a recession, the inflation is going to come down. And I mean, that is pretty much what we're seeing real time via our Trueflation dashboard. But now that we got this slightly higher than expected PPI, now suddenly every big investor, every big economist, they no longer have like that confidence that inflation is coming down precipitously and it's no longer an issue. So it's kind of like markets being hurt by a weaker economy while also being hurt by, hey, maybe inflation's not going to go away. And suddenly for our CPI data next week, I don't really have much confidence that that's going to come in light because it's pretty much tracked very closely with the PPI. And then also for that Fed meeting that's coming up on Wednesday, Jerome Powell no longer has that green light and that license to just say, all right, we got inflation, it's looking a lot better. We're going to focus on full employment. We don't want to over tighten. Now suddenly it's like he doesn't really have the license to say that because the data on the inflation side is still just not quite where we want it. So you can see we did have weakness in the market. We actually cited this early on and I was piecing out of exposure the entire day because I could kind of see the writing on the wall for the Santa Claus rally. Most noteworthy right here, is the TLT. I think this really tells the story. It was down 2.6% today. And remember, the TLT has been increasing in value over the past month or two due to investor fear over recession. So we got better than expected inflation data and that really hurt the TLT and it led to some strength in the dollar. So we could end up in a situation where investors, they're like, you know what, maybe the Fed is going to have to do a little bit more, or maybe the market's pricing in these Fed rate cuts in the middle of next year. Suddenly it's like, are those actually realistic? They might not be. We had an up volume of 48.1% today. Our trend model flipped back to a -3. We did have some relative strength in social media companies, innovative tech, telecom, and cannabis. But for the most part, the market was sold. And you can see from our trades today, you start doing the math into the end of the year, well, what catalysts are left? Where's the market technically? Where are these fund managers in terms of performance? Where's the trend model? And after looking at those things, I was like, honestly, I feel like this year is kind of done. Perhaps we get some sort of Santa Claus rally, like who really knows? But in order to get that, you do need some sort of catalyst, some sort of good news, especially when you're in a market environment where monetary policy is tightening. The liquidity situation is actually getting worse. This was from earlier today. Yeah, the PPI was pretty ambiguous. Odds are fair that we ping pong around for the next few days, these events unfold. And yeah, we just said this year is pretty much in the books. Now it's time to review 2022 and how we can get better for 2023. So we closed out TARK. We closed out half of it this morning at 946. We sold it into strength, which was great for 2 times our risk budget. I closed out the remaining 25% of MBLY for a nice winner. A smidge over 2 times our risk budget, which is great. I closed out Crocs for a 0.25 risk budget loss. So that's good. If we're closing things out for like 2 times our risk budget on the long side, and then when things don't work out, it's a very small loss. That is perfect. And I closed out the remaining TARK as well. I also cleaned up some options trades. So this was the ARK Innovation ETF. Took this trade earlier on in the fall. These were call options, thinking that we could get, deceleration in inflation. This group could advance. We got the deceleration in inflation. We got the rally in rates. The ARK ETF just did not participate. This thing has just had significant negative alpha. And this was definitely the biggest tactical error that I made in 2022. Getting long this group, getting involved with this ETF, this thing was just showing big relative weakness. And yeah, that's why we typically avoid those groups. And then the same thing with this Tesla position as well. These were some December 16th, 195 calls. Originally took these because there were some headlines about a potential new CEO for Twitter, but that just didn't play out. And we just kept getting bad piece of news after bad piece of news related to Tesla. So again, it really just comes back to, just focusing on those relative strength names. The S&P 500, technically, it's broken. It's broken already. The trend model's at a -3. And I think we're still at that stage where people might have some hopium, but it's like, we just had a big rally and like, we're still kind of close. It could be there. But I think today's catalyst and the way that it all went down, I think it's just such an uphill battle into the end of the year. We're below this monthly point of control. We pretty much tagged the 20-day simple moving average and we came off of it. We ended up closing on the lows. And the pattern that we're in right now, it just looks a lot like a head and shoulders pattern. So I do believe that the next destination could certainly be this 50-day simple moving average and potentially this monthly value area low at 3826.25. So it's just not really the best look. I noticed as well throughout the session that even when the S&P 500 was flipping positive, the VIX just really wouldn't budge and it remained green throughout the whole session. And then of course our treasuries were just a smidge weak throughout the session. Still look relatively intact, but again, a bit of weakness there. Even some of the leading stocks like AEHR, this one had a nice bounce, but it just made a lower high. SMCI, again, this name, you could really just hold on to that hope. Like, this is a leading stock. We could turn around, whatever. But the reality is that for the S&P 500, as well as many of these leaders, we're getting price acceptance below the 20-day SMA. And the rallies are kind of getting sold into. Or not kind of, they are getting sold into. So we're just getting a lot of evidence that, hey, trend model's negative. The catalyst we were looking for didn't necessarily go our way. There's no reason to be super hopeful into next week's Fed meeting. So that is why we've pretty much closed out a ton of exposure. Right now I'm sitting in, I believe it's like 87% cash. And that is really what I feel most comfortable with heading into the end of the year. With that said, we're going to be putting out our weekend market analysis video this Sunday for all Pristine Capital members. We're also going to be putting out our weekend watch list video on that same day. Feel free to visit pristinecapital.net if you want to receive that analysis. With that said, hope everyone enjoys their weekend and we'll see you all next time.